Thank you so much to Freddie and Adam for joining me today. And I'm so anxious to hear their update for the first quarter and then looking forward. So let's see, Adam, first with you. What's happening with inflation? And do you expect inflation rates to change this year?
Yes, I mean, the rate of inflation, or I guess the growth of that rate of inflation is falling. So we're seeing CPI and PCE both start to drop on a year-over-year basis. I think the important factor is that it is dropping a bit slower than was originally expected. If we look back to kind of the beginning of last year when we were talking about, there's a 99.9% probability of a recession in 2023 that obviously didn't happen. A recession would have been the thing to push inflation down more quickly. So we haven't seen any of that. We've seen spending continue to remain elevated. The consumers remain very strong, and that's really on the back of better than expected employment through this cycle. So inflation is coming down, but if we keep in mind that the Federal Reserve has a target of 2% inflation, and we're still with a 3 handle, there's quite a bit to go here before we kind of get to that target rate.
And let's see. Thank you, Freddie. What's your take on the S&P 500's very rapid growth? And do you think this growth can continue?
Well, we think the rise so far is pretty surprising. After a 26% rise in 23, for the S&P to start 9% in the first quarter is a bit much for us. Currently trading at 24 times earnings. We think that earnings are going to play a really big factor going into the year. We saw 8% earnings growth in the first quarter. That is lower than initially expected, which was 12%. So really, you really need the S&P to report double-digit earnings growth over the next couple of years just for the valuation to make any sense. So at 5,200 on the S&P, we're looking at it probably close to 5 to 10% overvalued right now. So can it continue? It's possible. More momentum is a very strong factor. That's hard to bet against, but we are taking the other side of that bet.
Yeah, and statistically, we're way overdue for a 10% correction. Let's see, and then I get this question quite a bit. Do you have any exposure to the Magnificent Seven stocks?
Yeah, so in the ETF models we run, indirectly, just given we own the broad market, the Mag 7 makes up 30% of the S&P right now. So we have exposure to all of them. In terms of specifics in the equity models that we run, we hold 6 of the 7. The one that we don't own being Tesla, as we've seen a 35% decrease in its stock price over the last few months. We have a lot of questions regarding EVs in China, all the competition that they have. They're cutting prices quite a bit, which are significantly reducing their margins. So to answer your question, we do have indirect exposure through ETFs, as well as we own 6 of the 7 in our equity models.
One thing I'd like to say there, if I could, if you look, especially in the core models, that we have taken a stance that's more defensive against the Mag 7. We have some holdings in equal weight ETF. So in the core models, we own the S&P 500 and S&P 100 equal weight. So that obviously reduces the exposure to the Mag 7. And then subsequently in the sector models, we also own some equal weight sector ETF. So that is one way that we're mitigating it. So while we do have the exposure, I would say it's considerably less exposure than if you were just to go out and buy the S&P 500 on its own.
Okay, yep. Let's see, and back to you, Adam. Will the Fed's policy be a main driver of capital markets this year?
Yeah, unfortunately, that's kind of been the theme, right? That 2023, everyone was focused on every single Fed meeting, and it seems to kind of be the same case. Everyone's focused on, dot plots and, how he uses terminology and vocabulary. But so I do think that will be the main focus, because everyone's trying to determine whether we do get any interest rate cuts and whether there's a reason to cut interest rates, because that really is a tell for the economy. And we were joking yesterday with a group that, why was the S&P 500 down so much? And we've entered that awkward part of the market where good news for the economy is bad news for the market, because if you see a good data report, it means the Fed likely will not cut rates, and then you see stocks drop. So it's a awkward time to be an investor, but that's why you just kind of stick to the asset allocation and ride this out.
And so how many interest rate cuts do you think will happen this year?
So we started the year with a different opinion in the markets, and we were saying, it would be a lot less than 6, maybe 2 or even 1. I think we're starting to get more towards the camp of maybe none at all. So I think we're in the place where maybe 1, which is signaling towards the end of the year. But there's a growing probability that there won't be any cuts this year at all.
Oh, wow. Okay. Let's see. How are consumer spending rates impacting markets? And has this changed in the past quarter or year?
So that plays right into kind of why there wouldn't be any cuts. As I kind of spoke at the beginning, the consumer has remained quite resilient, and that really is because there hasn't been any real increase in unemployment. You're still seeing wages increase, and actually seeing real wages start to increase as inflation comes down. But wages are much stickier. You're seeing that the spending power of the consumer has been resilient, even though there's a lot of factors fighting against that. So that's what could keep the Fed in a more tight policy, because obviously if you see consumer spending stay at its current levels, that would turn itself into keeping inflation above that 2% target. So that's kind of the dynamic we're dealing with right now with the consumer versus the Fed.
Freddie, are there any sectors that you think will outperform the market this quarter?
Yeah, so 2 overweights that we're taking heading into this quarter are healthcare and communication services. Healthcare is just a low-baited, the defensive sector that we really like right now. Companies within the sector are showing very strong fundamentals, low valuations, and it has quite some momentum with the weight loss drugs that are being led by Eli Lilly. So currently at 19 times earnings, it's a little below historical averages, and we think it'll outperform over the next quarter. So we have an overweight in healthcare. And then the other one I mentioned was communication services. Now, 30% of this sector is actually made up of Meta and Google. And of the Mag 7 stocks, even after the rally, we find that the valuations of both of these stocks are actually pretty reasonable. So Google's trading at 22 times forward earnings, and then Meta is trading at 24 times forward earnings, which you'll find is actually a lot cheaper than the tech sector, names like Microsoft, Apple, NVIDIA. So we do see some upside in communication services. And on top of that, if you look at the top 10 holdings, they're trading actually at a 20% discount to their 5-year historical average. And this includes names like Disney, which we like to have further upside ahead as their park segment continues to show strength, and they're sort of having a revival and they're in the content space as well. So those are just 2 of the sectors that we're overweighting.
Okay. And then have you shifted your portfolio asset allocations this past quarter?
Yeah, so not including the overweights that I just explained in the core series model, we added to MBB. That is the iShares MBS ETF. And what this is just an ETF of mortgage backed pass-throughs that are backed by government agencies. So the intention here is basically to raise our duration. It's a duration bet, while simultaneously moving into a high quality asset class. And this is coming from SCUB, which is our short-term T-bill ETF. So mostly it's just a way to extend our duration while continuing to play it safe. We haven't seen yields in MBS since I've started in the business. I'm sure Adam could tell you more about that. But
yeah, just to add a little more detail to it, obviously it's to lock in the higher interest rates for longer, because with a short duration it could go away. But the dynamic we saw in mortgage-backed securities, and these are AAA rated mortgage-backed securities, very, very safe. But banks held all this paper, and this time last year, because of liquidity issues, they were forced to sell. And so when you have massive buyer go away and then have to sell, it made the prices go down, and so that would just created this opportunity where we're able to get much higher yields than I've ever seen in 10 years of doing this in the mortgage sector. So it was a no-brainer for us.
Great. What kind of yields do you see?
We're talking 5.5 to 6% for AAA rated bonds.
Great. Well, you guys, thank you so much for this overview. I really appreciate it. Anything else you want to share with our clients?
No, I think that's good.
Well, good. Well, thank you so much, you guys.